Today, Bitcoin notches a rebound after a weekend of trade-driven selling pressure. And James Davies of Crypto Valley Exchange discusses how long tariffs and economic uncertainty could put the pressure on crypto. Welcome to CNBC's Crypto World. I'm Mackenzie Sigalos. Crypto markets bouncing back from their lows of the morning after being hit hard by a weekend sell-off. Bitcoin tumbled from $102,000 on Friday to as low as $91,000 after President Trump slapped sweeping tariffs on Canada, Mexico, and China. By noon Eastern today, though, the cryptocurrency reversed course to $98,000 after the U.S. paused those tariffs on Mexico for 1 month. Ether wasn't so lucky, tumbling 10% in the past 24 hours to $2,700 by noon Eastern. Solana was just slightly higher at $208. Crypto-focused stocks were hit by selling pressure too, as Wall Street faced tariff-driven declines, but the breadth of those losses varied. Bitcoin miner Mara Holdings, for example, dropped 4.7% by around midday, while Bitcoin proxy MicroStrategy dipped around 0.8%. Okay, let's keep talking about markets for our main story today. Bitcoin and Ether faced millions of dollars in liquidations amid the sell-off. I spoke with James Davies, co-founder and CEO of futures platform Crypto Valley Exchange, for his reaction to the drawdown and how long this volatility could last. So crypto just saw a huge liquidation event over the weekend and into this morning. The catalyst for this pretty clearly appears to be the tariff announcement from President Trump, but makes sense for me why we saw such a sharp decline and what mechanisms really led the losses.
It started with the macroeconomics and all of the assets, not just crypto, but everybody looking to get liquid, to get into cash, to be able to cover different risk in different places. So there was always an expectation that people will need cash to cover collateral, to cover margin calls, and crypto essentially is one of the most liquid places that they can take that capital from. It's somewhere that if you have it in your portfolio, you know you can exit very, very quickly and make that available. So lots of institutions did that. But what we saw was some knock-on effects of that. We saw that start in Bitcoin, but then across the alts, we saw a big hit. And we saw that hit because people were starting to retract from the market making space as well. We saw the markets going thin. So we saw that really go through very rapidly and option premiums jump. And then towards the end of that cycle, we started to see the capital coming back in, people settling, and a little bit of a bounce coming back, which is something that we often see in liquid assets when they're tapped in these events, because people will sell the liquid assets to make sure that they're able to cover impending risk that they see in the market.
We really saw this robust build out of the crypto derivatives market over the last few months, more product offerings across more exchanges. Did that factor into why we saw such outsized moves this weekend and into today?
I think to a certain degree, yes, because it spreads the liquidity out. There are not as many good places to move the liquidity around rapidly. And when you find yourself short of collateral to cover a set of exposures, say you have some options exposures and you need to bring collateral in because you're short vol, which the market makers are almost always short vol in this space, they need to bring collateral in relatively quickly, and that's got to be pulled from somewhere. So you start to see the markets going thinner on the perp side. You start to see markets going thinner on the altcoins, or where there is more speculative expectation. And that's all being sucked into margin calls in the short term to cover the need to keep the positions that are not as liquid.
Are we seeing a pivot back to this macro environment being a focus for crypto rather than the Trump trade?
I think today's macro environment, where we've seen this return and everything started to rally back up, is people now realizing that some of the other assets they have, they've been able to liquidate those, and that their bets, their structural long-term bets, were crypto. They feel like this is going to be something that, even in a high tariff world, it's a free trade product. The crypto is there to facilitate the free trade. So making it available, having their positions and the speculation back into it is where they wanted to be. But they needed the capital in the short term. As other assets liquidate, they can go back into those positions. So we saw a lot of that strong bounce and everything coming back to where it was.
Now, some people we've spoken to have been worried about this idea of a bubble growing in the crypto market, both from excitement about the changing regulatory landscape in the US, but also because of some of the hype around meme coins, including the ones that we saw launched by President Trump and his wife, Melania. Are you seeing risks of a bubble right now? And what's the market telling you?
So on the meme coin side, I think that's something we've seen cyclically 2 or 3 times over the last year and a half. But that bubble really sits in a non-systemic way. It sits with a whole bunch of retail people who will get burnt, unfortunately, in that cycle as each of those memes goes into fashion, that comes out of fashion. Very few of them will remain around in the long term. More systemically, I worry about the huge explosion in OTC trading that we've had, where very large portions of the market have come away from the centralized exchanges to the large market makers, and what the risks are amongst them and how well understood that is. That feels more systemic.
So when you say systemic risk to the institutional side of the marketplace, what do you mean by that?
I mean, we've seen a change this year in the dynamics from centralized markets towards a very large amount of OTC business. The OTC business is the different market makers and large trading houses all doing business directly with each other or via some intermediary brokers. The amount of risk that they hold against each other is opaque. We don't really know. And even versus the centralized exchange, a lot of the collateralization deals there are done on a handshake. In fact, that's the standard model, is how much money you need is based on a handshake. That means we don't really know how much risk there is. This reminds me of 2008, when everybody had different CDSs and CDOs against each other, and we didn't really know how much risk there was in the business and how much people had against each other. And with this big growth in OTC across the marketplace, that's where we are in crypto at the moment. Maybe not to the same scale yet, but OTC is growing much more rapidly than centralized exchanges. And it's something that we need to keep an eye on. And I think it's something where over this weekend, when people were worrying about risk and volatility and they came out of the market quickly, they all had one eye on what does each other have in the back room, written in a ledger somewhere.
Are markets too US focused right now? One of the points of crypto is that it wouldn't be beholden to one government or entity, but right now it feels like the United States is having an outsized influence on what's going on in crypto markets.
I think the dollar is having the outsized influence because everything that's priced in dollar is going to move quite rapidly if the dollar gets stronger. And what we've seen is everything else come across. So the market certainly didn't retreat as far when you look at it through the lens of euro, you look at it through the lens of sterling. But we do tend to be very reactionary from the perspective of speculative trades from what's going on in and around the US. And its impact on world trade is very significant. But there is a very large market that isn't there. So there are 22 million people signed up to the 4 brokers that are in Indonesia. Now, individually, they don't have the same capital as the people in the US with them. But this is a massive marketplace. They can swing things a lot if they're moving things around. Over this weekend, we've had the Lunar New Year. So there's a lot of people out of the market. So particularly this weekend, we've had this trend where the US-led speculators were doing a lot of that legwork because a lot of people were out of the market, not speculating, not taking short-term positions as they celebrated Lunar New Year all across Asia.
So how long is this increased volatility here with us, and what should people following crypto know?
So we're going to see some volatility immediately coming off. The spike that we saw came back very, very rapidly. But right now, people look for certainty. Everyone who trades wants certainty. There's a lot of uncertainty around trade, around FX, around international tariffs at the moment. That's going to add to the volatility. That's going to add to the premiums. That's going to add to the frictional costs in the system. I don't think that's going to go away soon. Whatever you think of Trump, he is somebody who does tend to bring volatility to a situation. And we're going to see that right the way through the crypto markets as we see what happens with regulation in the US and we see what happens to international trade and how people start to use crypto as different aspects of that.
Okay, that's all for Crypto World today, but we'll be back again tomorrow, and we'll see you then.